If you haven't been living under a rock, I'm sure you've heard the story of Roaring Kitty.
Cheers, everybody!
Just a regular dude who made out like a bandit on GameStop to the tune of a $20 million profit.
I like the stock.
You can see in the screenshot here, Roaring Kitty loaded up on stock and this call option. And while the stock was up 600%, certainly nothing to bat an eye at, the call option was up 87,000%. And the call option alone allowed him to turn $10,000 into $9 million.
Show me the tendies, everybody.
Yes, you heard that correctly, 10,000 into 9 million. If you also made some money on GameStop, let me know in the comments below. I personally missed GameStop, but I did catch a small trade in AMC, which followed shortly after. Now buckle up, because in this video, I'm going to teach you how to trade call options. Because although stock moves like the one in GameStop don't happen often, you can still use call options to make double and triple digit returns even with just regular daily market fluctuations. If you're new to the channel, my name is Adam Thomas and I'm the head trader here at Skyview Trading, and our job is to make trading very simple and effective to help you maximize your trading results. Because options trading is not as complicated as it seems. It's actually extremely simple once you see how it works. And that's why in this video, we're not just going to explain the basic boring definitions to you. Instead, we're going to break it down for you in a very easy to understand way. And on top of that, we're going to show you some live trading so you can get a hands-on understanding of how the process works, but without putting your own money on the line yet. So if you learn best by doing, then this video is for you. Let's dive in. There are two types of options, call options and put options. But in this video specifically, we're going to be covering how to trade call options. So first, what is a call option? It's a contract that gives the option buyer the right, but not the obligation, to buy shares of stock at an agreed upon price on or before a particular date. Think of it like this. Let's say you have your eye on a Rolex watch, and this watch is a limited production and the deal very easily could pass you by. But you still don't want to pull the trigger just yet. What if you could buy the option to buy the watch at a future date? Buying the option to purchase the watch allows you to go ahead and lock in a price for the watch, giving you the flexibility to decide later whether or not you want to go through with the purchase. So for example, let's say the current price of the Rolex watch is $10,000, and you go ahead and purchase the option that locks in this current price of $10,000. And let's say this option you purchased gives you 2 months to make your decision before it expires. And obviously nobody would be crazy enough to offer you such a deal for free, so you're gonna have to pay a small amount of money for the option. Let's say it costs you $500 for this 2-month option that again gives you the right but not the obligation to purchase the watch at $10,000 anytime between now and when the option expires in 2 months. All right, now let's talk about two potential scenarios. Over the next 2 months, the watch either increases or decreases in value. If the watch increases in value, and let's say it explodes from $10,000 to $15,000, great, because now you can exercise your option to purchase this watch at $10,000, even though it's worth $15,000 on the open market. And of course, if you wanted to flip this watch for a profit, you could buy it at $10,000, immediately sell it at $15,000 for a $5,000 profit, minus the $500 you paid for the option for a net profit of $4,500. Now, this is where it gets fun. Let's say you don't want to put up the $10,000 to purchase the watch. The good news is you don't have to, and you can still cash in on your $4,500 profit. You own an option that gives you the ability to purchase the watch $5,000 below the current market price. But instead of exercising this option, you can just sell it to someone else. And guess what? Since it gives the new option buyer a $5,000 discount, how much do you think they'll be willing to pay for this option? That's right, at least $5,000. So an option you bought for $500 is now worth at least $5,000. So instead of scrounging up the $10,000 to buy the watch, you can just sell the option for a profit. Boom, a $4,500 profit, and the only capital you had to put up was the original $500 you paid for the option. You were able to capitalize on the watch increasing in value, but without ever purchasing the watch itself. Kind of like buying a coupon on something and then selling it for a higher price as the underlying asset rose in value. Now, the other scenario is, what if the watch decreases in value after you purchase the option? And it goes from $10,000 to, let's say, $8,000. Well, thankfully, you don't own the watch. You only paid a small amount of money for the right but not the obligation to buy the watch at $10,000. But of course, you're not going to exercise your option to purchase this watch at $10,000 if you could just go out on the open market and buy it for $8,000. So in this scenario, the option you paid $500 for now has no value to you or anybody else. So it's now worthless. And therefore, you just lost the $500 you paid for the option. Now, it's never fun losing money, but at least you only lost $500 because if you would have bought the watch outright, you would have lost $2,000. Now guys, this entire watch analogy we just showed you is exactly how trading call options on the stock market works. A call option, again, gives you the right but not the obligation to buy shares of stock at an agreed upon price on or before a particular date. Now, a couple other terms you need to know. Strike price. The strike price is just what we call this agreed upon price, right? In the watch example, the strike price was $10,000 because that's the price we locked in the watch at. And lastly, this particular date is just the option's expiration date. Now, what's awesome about this is all of the biggest and most popular stocks have a highly liquid options market in which you can buy and sell options within milliseconds at the click of your mouse. You don't ever have to touch the stock itself. You don't have to hold these options to expiration. A lot of people think that's the case. No, you can just buy and sell them at any time before the expiration date, and you're just trading the fluctuating option prices themselves. The goal, just like anything, is to buy low and sell high. In fact, let me show you just how easy it is to trade an option. Here you can see a list of options on ticker symbol QQQ, which is just the NASDAQ ETF, and there's tons of options to choose from, and you can see just how liquid all of these options are. Plenty of volume on all these options, and you can see the bid-ask spreads are very tight. Now let's just buy one of these with real money so you can see how it works. Now later in the video, we're going to talk about how to choose which option to trade. But for now, I'm just going to choose the 293 strike call option with 1 day to expiration. So here you can see the order to purchase this option. You can adjust your position sizing, your limit order price, and so on. But I'll just leave it at the current ask price of $240 and click review and send. All of this looks good, so I'll send the order. And boom, there you go. You can see the option filled at $240. Now guys, as we watch this trade play out, I want to point out a few things. First, we have the ability to sell this option at any time between now and expiration. We can buy and sell these option contracts just like we can buy and sell shares of stock. So you can see a running P&L here, currently up a small amount on the trade, and we can sell this option anytime we want. Second, stocks trade in shares and options trade in contracts. And you can see we purchased one contract of this call option. Now you can see this option has risen from $240 to $252, but I'm up $12 on the position. I only bought one contract, so shouldn't I be up 12 cents? No, and the reason is because one option contract controls 100 shares of stock. And because of this, option prices have a multiplier of 100. So in this situation, I'm up $12. If I bought two contracts, I'd be up $24. If I bought 100 contracts, I'd be up $1,200. I know if you're new to options, this may seem confusing. I promise you get used to it very quick. But an easy way to think about it is just simply remove the decimal point. I paid $240 for this option, but if you remove the decimal point, I really paid $240, and that option is now worth $256. All right, now as we watch this trade play out, you'll notice as the stock is going higher, the call option is also rising in value as well. This is because, remember, the option gives us the right to buy shares at $293. So of course, as the shares rise in value, the option will rise in value. And this is exactly what we want to happen since we own this option. In fact, we're showing a pretty quick profit, so let's just go ahead and sell it. And there we go. You can see we got filled at $276. Now, if we look at these transactions, you can see we paid $240 for this option, and we were able to sell it for $276. That's a profit of $36 on a $240 investment, which is about a 15% return in about 6 minutes. And in that same 6 minutes, the stock only moved about 0.25%. The stock barely moved. Imagine what the option would have returned if we got a big move in the underlying stock. But guys, this is why someone might buy a call option instead of trading the stock itself. You can make big returns on small amounts of money, and with large amounts of money, you can make huge returns. But before you go buying call options on every stock you think is going to go up, keep watching because we're going to talk about how to choose which options to trade, and we're also going to talk about some other factors that will affect the option's price. In other words, just because the stock goes up in value doesn't always mean the call option will also go up in value. The stock price movement is just one factor. There are some other very important factors that can make or break your option trades. But real quick before moving on, let's just do a quick recap of everything you've learned up to this point. First, you learned the definition of a call option, which is just the right but not the obligation to buy shares of stock at an agreed upon price on or before a particular date. And that agreed upon price is what we refer to as the strike price, and that particular date is just the option's expiration date. You've also learned that call options generally increase in value as the underlying stock increases in value. Next, options trade in contracts, just like stocks trade in shares. It's just the terminology. But of course, everything is electronic, so you can buy and sell these contracts within milliseconds at the click of your mouse, just like you can buy and sell stock. And lastly, you learn that one option contract controls 100 shares of stock. And because of this, option prices have a multiplier of 100. So if you buy one option contract at $2.15 and sell it for $3.55, you really paid $215, sold it for $355 for a net profit of $140. And lastly, you learn that Skyview Trading is the best options education on YouTube, and you may want to consider liking and subscribing so you don't miss any future trading content. All right, guys, now back to this part specifically. We know that options are affected by movements in the underlying stock price, right? Call options generally go up in value as the stock goes up in value. But sometimes the stock will go up in value and the call option will go down in value. And which option you choose to trade can greatly influence not only if you will make money, but also how much money you will make. This is because option prices are influenced by more than just the underlying stock price. Another one of those factors is time to expiration. Guys, time to expiration is huge. Let me show you how this works. You're looking at some call options here that are about to expire. You can see the number of days left to expiration here, and the market just closed. Now, these options you see here are what we refer to as out of the money. This just means they have a strike price that does not allow you to buy the stock at a discount, right? For example, who would want to buy the stock at $4.45 if the stock is currently at $4.43? Nobody. That's why all of these out of the money options are worthless. And these options are what we refer to as being in the money. This just means they have a strike price that is lower than the current stock price. So they do provide the option owner with a discount on the stock. And because of that, you can see they have value. You can see the 443 strike call option is worth 13 cents. The 442 strike is worth 113 and so on, because that's the exact amount they are in the money. In other words, that's the exact discount they give the option owner on the stock. Now, an option's price is made up of intrinsic and extrinsic value. Intrinsic value is simply just the internal value of an option, or in other words, how big of a discount they provide. And extrinsic value is just anything extra on top of that. Well, you can see with these options, there is no extrinsic value at all. You can see the in-the-money options are all pretty much just worth their intrinsic value, right? This 442 strike call option, for example, is worth about 113 because the stock is currently at 443.13 per share, which is about $1.13 above the strike price. So it's just worth its internal or its intrinsic value. Now, the out-of-the-money options don't have any extrinsic value or intrinsic value. They're like worthless coupons. Nobody wants them. They don't provide any discount. And remember, these options have 0 days to expiration. But now let's look at the options with 16 days to expiration. Now, just to simplify this a bit, let's look at these options side by side with the ones we were just looking at that had no time left on them. And we'll just take an in-the-money and out-of-the-money option from both expiration cycles. You can see the 442 strike call option with 16 days left is worth quite a bit more than the one with 0 days left. And the out-of-the-money 445 strike call option with 16 days left is worth about $3.63. While the 445 strike call option with no time left is completely worthless. These options with 16 days to expiration are so much more valuable because there's still time for the stock to move around. There's still time for this out of the money option to become in the money, and there's still time for this in the money option to become deeper in the money. And this is why extrinsic value of an option exists, because there is still time for the stock to move around. And it's also why you'll often hear option traders refer to extrinsic value as the time value of an option. Now, the more time there is to expiration, the more time value there will be on the option. For example, you see the price of the 445 strike call option was 0 and 16 days left, but let's also grab the price from the same strike call option at the 30-day expiration and also at the 44-day expiration. Now remember, all 4 of these options have the exact same strike price. The only difference is the amount of time left they have until they expire. Let's put these option prices on a chart. So think about what this does to an option's price if you buy it. Let's say you buy this 445 strike call option with 44 days to expiration for $7.93. And nothing happens with the stock and it just kind of trades sideways for 14 days. It's now going to be worth $6. Then finally, if you hold to expiration and the stock still didn't move, then the option is going to become completely worthless. Because remember, as you learned, out of the money options at expiration are worthless. So naturally, option prices decay due to time. This is called time decay. And if you're buying options, you're always going to be fighting this time decay. It's the price you pay for the outsized returns you'll make if you nail the timing and the stock explodes and your option becomes deep in the money. Each and every day, these options are decaying in value. So as you can see, timing on your entries and exits are very important. This is why people say buying options is very speculative, because not only do you have to be right about your prediction on the stock, but you also have to nail the timing so you can minimize this time decay that is against you. Now back to this chart, you can see the time decay of this 445 strike option is not linear. It accelerates as we near expiration. And this is pretty much exactly what the textbook time decay curve looks like. This graphic is pretty common knowledge when learning about options, and you can see it represented pretty well here with real option prices. What's important to understand right now is that an option that is closer to its expiration date will generally move quicker, meaning it will decay at a faster rate due to time, but it will also be more sensitive to changes in the underlying stock price. Let me show you what I mean. We're about to look at the trading activity over a full trading day on the gold ETF, and also watch the movement of 3 different options, each of them with the same strike price, but with 3 different expiration dates. You can see the option with 4 days to expiration starting the day at 81 cents, the option with 18 days left starting at 176, and the option with 60 days left starting at 393. And if we start this time lapse, you can immediately see the option with the least time to expiration is the most volatile. With the shares up just 0.3%, you can see the 4-day option is up close to 35%, the 18-day option is up 19%, and the 60-day option is up 8%. So again, this perfectly demonstrates how an option with less time to expiration will be more sensitive than an option with more time to expiration. And now as we watch the rest of the day play out, you can see where these options close the day. You can see the stock gives up all of its gains and pretty much closes right where it started. But if you look at the options, you can see the 4-day option is actually down 9%, the 18-day option is down 1.7%, and the 60-day option is down 0.7%. So again, less time to expiration means more sensitivity, not just to directional moves, but also to time decay. As you can see with the stock pretty much flat, all of these options have lost value to time decay, with the most extreme being the option with the least time to expiration. So with this new knowledge, let's talk about how this could affect your decision in choosing which option to trade. And for now, we're only focused on expiration date selection, which is the first step in the process. Then we'll cover strike selection. I'm going to keep this section short since it's fairly simple and it greatly depends on your trading style. But expiration date selection is all about just making sure it aligns with your outlook on the stock. If you're making a day trade, for example, you're not going to want to trade a 120-day option because it's really not going to react much to any intraday movements in the stock. It's going to have a ton of extrinsic value and it's just not going to be very sensitive to any intraday movements that you're looking for in the underlying stock. And if you're swing trading, looking for a move over a 2-week period or so, then of course you're going to need to choose an option with at least 2 weeks to expiration. One last thing I'll say is trades rarely go perfectly to plan, so it's better to lean towards choosing too much time than too little. Of course, choosing the shorter expiration will make the most money if things go perfect, but sometimes having a little more time to expiration, in case your timing isn't perfect, can be nice. Now, we've discussed all about how time will affect an option's price, and how as time passes, an option's extrinsic value will decay, and it will only be worth its intrinsic value at expiration, assuming it is in the money. And obviously, as an option buyer, you're hoping that the stock goes up enough to more than offset any time decay you experienced during the time you held the option. Now let's talk about choosing your strike price and how this will make a huge impact on how your trade will behave. Now, let's say you're bullish on Zoom for whatever reason, and you've chosen the expiration cycle with 9 days left, and you want to buy one of these call options. But which call option? Which strike do we choose? The answer is you can choose any of them, and there are pros and cons, but you need to understand how your choice will impact your trade. And let me just do a quick demonstration. Let's just take note of the stock price and a few of these call options. And we'll grab these 5 call options here, the 65 strike, 66 strike, 67, and so on. And also let's go to both extremes and throw in a deep in the money call option and a far out of the money call option. Now fast forward 9 days, and let's say that during that time, Zoom went from $66.55 up to $73 per share. And that's where it lands at the expiration date. Now, you just learned in the previous section that an option will only be worth its intrinsic value at expiration. So if the stock is at 73, then what would the 60 strike call option be worth at expiration? $13, right? Because that's how far in the money it is. That would be its intrinsic value. And the 65 strike would be worth $8, the 66 strike would be worth $7, and so on. And lastly, this 75 strike call option did not become in the money, so it is completely worthless. So with the stock up 9.7%, you can see that these options are up quite a bit more than that. The 60 strike is up 87%, the 65 strike is up 193%, and so on. But you can see the cheaper options that were originally out of the money and became in the money provided the largest percentage returns. In fact, this 69 strike call option returned around 350%, meaning you could have turned $89 into $400, $890 into $4,000, or even $8,900 into $40,000. Now, looking at this, you may be thinking, well, why wouldn't I always just buy the cheaper out of the money options if they return more? Well, there's a trade-off for this. The further out of the money an option is, the lower your probability of making money will be. And you can see the perfect example of this right here with the 75 strike call option. The stock made a nice move of almost 10%, but still the move was not big enough for this option to become in the money, so it just went to 0. Now, if it did, however, let's say the stock, instead of going to 73, let's say it went to 78. You can see this option would have returned 2,207%. And that's exactly why we refer to buying very cheap, far out of the money options like this as lottery ticket trades, because they are very cheap and have a huge potential payout, but the likelihood of them making any money is very small. Now, options have what we call a break-even stock price. Very simply, the break-even stock price is just the price you need the stock to reach for you to at least break even on your option trade, assuming you hold the option all the way to expiration. Now, your break-even stock price when you buy a stock is very simple. If it goes up, you make money. If it goes down, you lose money. So the break-even stock price is just the price you pay for the stock. In this case, $66.55. That's your break even. But with options, we know the option will only be worth its intrinsic value at expiration. So we need the option to be in the money by the amount we pay for it. In other words, the break-even stock price when you buy a call option is simply just the strike price plus your entry price. So for this 60 strike call option, your break even is $66.95. If the stock is above that level at expiration, your position will be in the green. And for the 65 strike, 65 plus 273 is 67.73, and so on. You can see the higher your strike price is, the less favorable your break-even stock price is, which also means the lower your probability of making money will be, right? The probability of the stock skyrocketing to 75.13 is much lower than the probability of the stock getting to 66.95. The stock, which started at $66.55, has a much better chance of moving 40 cents than it does to moving almost $9. Now, I could make an entire video on probabilities, but for now, it's just important you understand the concepts. So let's recap strike selection. First, buying a cheap out-of-the-money option will have a much lower probability of success than buying an in-the-money option, but they can pay out big if the stock makes a large move. Next, the break-even stock price is equal to your strike price plus the price you pay for the option. You need the stock to be at or above this level at expiration for your option to make money. And let me reiterate, this is your break-even at expiration. As we talked about, options will fluctuate on a minute-by-minute basis, so if you still have a lot of time to expiration, you very well may make a big profit even if the stock isn't quite to your break-even point. Buying options will mathematically always have lower than a 50% probability of profit. Buying a stock with zero time decay is already around a 50% probability of profit. Now throw on some time decay and yeah, this is just the trade-off for the large potential returns you could make when you buy options. Next, buying very far out of the money options are like buying lottery tickets. You can choose to trade however you like, but we at Skyview Trading tend to refer to buying options like this as a sucker's bet. They tend to lure in very small traders with very little capital because they are cheap, but over the long run, it's highly likely you will lose money. And this is exactly why our option trading strategy at Skyview Trading is designed to be the exact opposite of this, where we're actually short selling these out of the money options and profiting from this time decay with an extremely high win rate. If you're interested in this style of trading, we put together a full training on how we do this, and you can check that out by clicking the link in the description. And lastly, buying very deep in the money options may provide a lower percentage return, but they can allow you to greatly reduce the time decay working against you. Many people refer to buying deep in the money options like this as stock replacement, just a cheaper way to get long the stock, but without the negative effects of time decay. Now, before you click away from this video and go watch all of our other videos, we gotta talk about risk. You'll often hear people say options trading is risky, and you've seen a few examples in this video how options can lose 100% of their value very quickly and easily. But I want to challenge your thinking just a little bit. Options trading can be risky. Yes, if you take a very large position on a far out of the money option that is probably going to go to zero, I think we'd all agree that's very risky. But options trading is a numbers game, and if you're able to formulate a winning trading strategy over a large number of trades, then risk really only comes down to your position sizing and/or poor execution. And you might be thinking, well, Adam, that makes sense, but what about time decay? I don't really want to deal with that. Seems like it brings a lot of risk to the table. Well, I'd actually agree with you. Putting time decay against you is a very challenging way to trade, and even if you find a way to do it profitably, it's going to be very hard to do it with much consistency. But there are two sides to every market. You can actually use options to achieve a very high win rate with lots of consistency by using options to profit from this time decay. Options are simply just a tool for you to use, and just like a sharp knife, if you know how to use it, it's actually safer and more effective than a dull knife. Options, when used correctly, can be far less risky and more effective than any other form of trading. And lastly, I'll leave you with this. On the topic of risk, Warren Buffett famously said, risk comes from not knowing what you are doing. In fact, Warren Buffett has traded many options in his career to boost his returns. So from now on, if you hear someone say options trading is risky, then you should probably stop listening to them because they have no idea what they're talking about. That's like saying using a sharp knife when you're cooking is risky. Again, options trading can be risky, but there are many ways to trade them. Now, if you're interested in our exact options trading strategy, we've put together a full masterclass. The link is in the description. We're going to cover a breakdown of our strategy, how it works, why it works, what options trades we're placing, position sizing, everything. And we're also going to cover how you can use tools to automate much of the process to take emotion and guesswork out of the decision making. This is really going to help you achieve consistency in your trading results. Again, the link is in the description and I will see you there. Otherwise, thank you for watching. I hope you learned something and I will see you in the next video.